Ladies and gentlemen, welcome to this Master Investor webinar, Going for Gold. Now, it's not a revival of the 1990s TV show that was hosted by Henry Kelly, but it will be just as international in its scope, and hopefully there will be moments of light entertainment. Now, the format of today will be as follows. It's a Q&A with Jim Mellon, the investor with more than the occasional Midas touch. He'll give his outlook on gold, followed by three companies presenting. Glint, a financial services company that has the who's who of the world's gold council on its board. We will have Barton Gold, which has 20,000 meters of drilling underway, and Condor Gold with its construction-ready La Indian project. And of course, we look forward to reading and fielding your questions throughout this session. So without further ado, we have Jim Mellon. So Jim, I'm going to skip your credentials as that would take up all the time that we have, but you are an experienced investor and experienced many cycles. And in terms of cycles, the bogeyman of inflation has returned to haunt us, though admittedly it was never that far away. So is this the perfect climate for gold to thrive?
That's a very good question. And I'll try and answer it, but my answers are going to be a bit hedged, like you should be in your portfolios anyway. As you know, the gold price has been somewhat disappointing in the last few months, notwithstanding the fact that we are in a period of fairly high inflation, and not just in the UK, but almost all the way around the world. And this period of high inflation is partly due to the Ukraine crisis, but mostly due to the excessive money printing by central banks over the last few years. And particularly during the pandemic period, there are signs that the inflation that we've been experiencing may be peaking, actually. Central banks, which have been behind the curve in terms of raising interest rates, are now getting on top of them, and maybe even too much getting on top of the inflationary pressures. At the same time as that's happening, you're seeing things like food prices going back below the levels at which they were prior to the invasion. Gas prices, albeit not known to most people, have actually fallen quite dramatically in the last 2 or 3 weeks, as Europe has basically filled up all its reserves. And you're seeing significant demand destruction in the price of oil, which has resulted in a very significant fall in the price of oil. So I would say that many of the inflationary pressures are abating. We don't know how labor is going to play out. In other words, I'm not talking about the Labour Party, but I'm talking about the price of labor. But if inflation proves to be temporary at the elevated levels, I don't think it'd be temporary in terms of the long term. I think we're in an inflationary era now, which could be 4 or 5% per annum for some time. Then you might see inflation being more moderate than hysterical people who were forecasting 18% inflation in the UK. As you may remember, Sarah, just recently, I think that was Citibank's forecast. They're going to be proven so wrong, it's not true. I mean, I think we're probably at peak inflation already at around the 10% level. And so high inflation obviously is good in some ways for gold, but rising interest rates are bad for gold because they represent a cost of carry effectively for a metal that doesn't yield anything. And you've got all sorts of whirlwinds around there. But if you're asking me what is my view on gold at the moment, I would say it's an integral part of any portfolio. It has proven its worth. If you've invested in gold through any currency other than the US dollar, you've made money. US dollar and ruble, by the way, you've made money over the last year. You have to believe that we're not through the perils of politics by any means in the next year or so, and that at some point gold might just take off. So I recommend it for anyone's portfolio. And the last point I want to make is that, as you well know, there was some talk about how Bitcoin and other cryptocurrencies were going to be a better store of value during inflationary periods than gold, and it has absolutely not been the case. Crypto has been fried. Gold has, as I said, increased in value in every single currency apart from the dollar and the ruble in this period of rising inflation. And my expectation is that we're going to see we will at some point, like we do in every commodity cycle for various commodities, but particularly in gold, we will see a dramatic upsurge way above the 2000 and something level that we saw in September last year. And one of the forward indicators of that is that silver, which I don't know how many people on the Master Investor show are following that, but I would say silver is something to watch, because silver has been rising in price almost surreptitiously over the last couple of months, quite dramatically, actually. About by $3 it's gone up and per ounce. And silver is a very good precursor to performance in gold. So you should listen to the people after me, because they are living and breathing gold. But as an intuitive and also research-driven investor, I would say you cannot afford not to have gold, silver, palladium, and other precious metal groups in your portfolio. You're mad if you don't have it at this stage.
Well, let's not go to those presenters yet, because I'm not finished with you, because right at the beginning of your answer, you spoke about the Ukraine. Now, today, Putin is calling up his reservists. He's mentioned war for the first time. And it sounds as though the political situation is becoming even more hairy. So I just wondered if that would increase gold as a store of value.
Well, it might do. I mean, we don't know what's going to happen in Russia and the Ukraine. I mean, it's so good that the Ukrainians are fighting back with such vigor and such success. But, Putin is a cornered rat, and cornered rats tend to lash out. And he has means of lashing out, which could be very deleterious to all of us, frankly. So we just don't know. And that's one of the reasons why everyone should have gold. Now, you get on the last boat out of Novosibirsk or wherever, and you say, I've got 10 Bitcoin, I'm going to send them to you, you'll just be laughed at. But if you've got some gold coins, then potentially you might be able to get out. So gold is a portable means of personal insurance as well as insurance in financial markets. And, we have to see it. In the first half of 2022, physical demand for gold increased by 12% to 2,300 tons. That is a sign that people are generally a bit worried, and that they, having seen the destruction in cryptocurrency prices, which to my mind is probably going to be ongoing. I don't see that we're going to see anything other than the continuing bear market in cryptocurrencies, but gold is the only viable alternative. However, it doesn't yield anything unless you're a gold producer and you're producing and you're able to pay dividends. And, John Maynard Keynes called it the barbarous relic. And, from time to time, it is a barbarous relic because there's a heavy cost of carry. And it isn't the great inflation hedge on a short or medium term basis that most people think. I've done some research into it. It's a great inflation hedge over the very long term, but in the very long term, we're all dead. So what we need to do is to play the cycle. Now, at the moment, I feel that the preponderance of factors in favor of gold way outweigh the negative factors, which are rising interest rates and possibly a lesser demand for jewelry in markets that are particularly like India and China, which are impacted by potential recession. But I think that investors, speculators, people who are wary about the economic situation will increasingly add to their gold positions. And as I'm sure some of your speakers later on will talk about, there is a very strong suspicion, not just in YouTube videos by fantasists and sort of maniacs, but there's a strong suspicion that the price of gold is manipulated and has been manipulated downwards rather than upwards and that at some point there will be a sort of release of that pressure cooker, and you could see gold. And look, if I had to have a bet on anything, I would say gold before the end of this year will be well above $2,000, which represents an excellent return for investors. And the US dollar, which has been remarkably strong and is way over strong at the moment, far too strong against most currencies, including the pound and the yen, many emerging market countries, currencies. The US dollar we are at the peak or close to the peak of the US dollar. I'm absolutely sure of that. Evil Knievel agrees with me on that. That's going to be a good sign. And so I would say that if the US dollar starts to waver, and there are signs in some ways that it is wavering, then that's really positive for gold, really positive for gold.
So let's go from John Maynard Keynes to George Orwell. It's a very Orwellian sort of Animal Farm question from Joe, who says, isn't the only thing that really matters for the gold price is the strength or the weakness of the US dollar? Strong dollar, bad; weak dollar, good.
Well, in dollar terms, that's absolutely true. And as I said, Sarah, and Joe, the listener with the question, if you are a Japanese yen holder, lived in Japan, then gold has been an excellent investment. If you are a euro investor, then you live in the eurozone, it's been excellent. In the pound, it's been a great investment. It's only in the US dollar that there's been a problem, and even then, it's not a dramatic problem like with Bitcoin, for instance. So I agree with you. I think if the US dollar starts to waver, and there are some signs. I mean, I think that the Bank of Japan, for instance, and I've absolutely got this wrong, so maybe you don't want to listen to me, but the Bank of Japan is sort of drawing lines in the sand because the yen is structurally far too weak for all sorts of reasons. And Japan is an excellent economy. It's not a bad economy. It's not Turkey or somewhere like that. And so if the yen starts to strengthen, then I think we'll see the pound strengthen. We'll see a lot of other currencies strengthening against the US dollar, and gold will go up. And as I said, because there are all sorts of forces that are negatively depressing the price of gold, it could go up very substantially. You could see short squeezes left, right, and center, which is why, you want to have 5-10% of your portfolio. It depends on your portfolio, obviously, but 5-10% of your portfolio in precious metals in one way or another. And why this is a very timely Master Investor webinar, because I think you and me, Sarah, when we look back in 3 or 4 months, as we talked before about various other things, we'll find that this was excellent timing, and that people who follow us might do very, very well as a result.
I'm just wondering what kind of a practitioner you are. Do you own 5 to 10? Is there 5 to 10% of your portfolio apportioned to gold? And how do you prefer to hold it?
Yeah, that's a great question. I mean, basically, the bulk of my portfolio is in property. All right, so let's exclude the property. All right, because I don't think that's what most people would consider to be a portfolio investment. I mean, if you were a large institution, possibly you would consider that. But if you take out property and you just look at stocks, shares, unlisted companies, cash and so forth, I would say 5 or 10% is in gold in one way or another. I have futures in gold, I have futures in silver, and I have a number of gold share investments. I don't have any ETFs, but for many people, ETFs are a great idea. I do have physical gold in the form of Krugerrand sovereigns and those sort of things, and that's really a kind of personal protection thing. And I'm not going to tell anyone where I keep them for obvious reasons. I don't even tell my dogs.
You anticipated my next question. Yeah, where do you keep them? But
well, I'm not telling anyone. And but sort of, so maybe one day it'll be like the Viking treasures. Someone will come across them with a metal detector and find my stash of coins. But the answer is, I think you should have a diversified portfolio. And so, and if you're asking me what stocks I own, there are a number of large gold companies which are very good investments. The ones that I happen to have include Barrick, which is the world's largest gold company. I don't have Newmont, and there's no particular reason for that, but I just happen to have Barrick. I've also got Kinross, which has not been a great share, but has a good yield and was somewhat tainted by the fact it has Eastern European and particularly Russian exposure, which is now got rid of. And I think Kinross is another good company you can have. And I'm the biggest shareholder of one of the speaker's companies later on, Condor Gold. And, you know, Mark and I are very old friends, and I support him in whatever way. But there are plenty of ways of playing gold. So this is my very quick rendition on that. You know, if you want ETFs, the IAU ETF is the biggest one, and it's a good mix of big gold companies around the world, and it's billions and billions of dollars, so there's lots of liquidity in that. The Aberdeen, spelled ABRDN in small letters. I mean, what a disastrous rebranding that was. But anyway, their physical gold ETF has a very low expense ratio. And expense ratios in gold are very important because it doesn't yield anything. So you're never going to be able to match the price of gold if you run an ETF, because your expenses are going to eat into the performance of gold. So that's one, which is SGOL. And then, you know, you've got Franco-Nevada, which is a very good company, which I came across long time ago through a friend of mine in Canada called David Hallington. And it's a royalty company. So they have royalties on lots and lots of gold producers around the world. I don't think you can go wrong if you buy any of those. And then the other thing to look at is silver, of course. And, you know, the gold-silver ratio has changed recently. The silver has gone up relative to gold, but it's somewhere in between its 5-year range and the top, the high and the low. And silver has a lot more industrial uses. It's harder to store because it's much more physically bulky. But, you know, you can buy Fresnillo as an example in silver. You could buy the silver ETFs. And silver's got greater volatility. So, you know, if you look at silver today, it's about $19.60 an ounce. Gold, I think, is around just under $19.80 an ounce. Sorry, 17. I wish it was $16.80 an ounce. I wish it was $19.80 an ounce. And I can see silver going up 50%, whereas gold goes up 30%. If you believe in the central thesis that the precious metals complex is on the cusp of a major bull market, which I do.
Okay, because you are exciting some of our audience about not just ETFs, but silver. Alexander says, what are your views on owning physical silver, Jim, versus silver mining shares or silver futures and ETFs?
Well, I mean, silver, I don't know how much Alexander wants to buy, but, you know, if you want to store a lot of silver, you've got to have a lot of space because it's very, you know, it's bulky compared to gold. Because, I mean, remember the ratio is 87 to 1 at the moment. That means that gold is 87 times more valuable per ounce than silver. So if you're wanting physical, I would buy gold. It's much more easily transportable. In silver, you buy ETFs or buy, as I mentioned, Fresnillo, but there's Wheaton Trust as well, which is another one you can buy. It's got a bit of a yield attached to it. You know, there aren't a lot of silver miners that you can buy out there, actually, especially now that the Russian market is shut for both gold and silver in many ways. So I like silver. I like gold. I think, you know, if you know what you're doing, buy platinum and palladium, buy them in whatever way you want. But I wouldn't go for a leveraged ETF. I wouldn't go for a leveraged position if you can't afford it in futures or in options. You know, we don't know the exact timing on this. I think this is like a rocket that will go off at some point. We don't know when the takeoff is going to occur. It's like waiting at Cape Canaveral for something to go to the moon. You could be waiting for weeks or months or even a year or 18 months. But the day that it takes off, wow, the fireworks will be incredible.
So let's explore timing, because Alex asks, if you add precious metal to your portfolio, at what point does it make sense to start to release profits? How do you make sure you don't hold too long or too short?
A very good question. I mean, I think gold is something that you rent rather than own for the long. I mean, I'm talking about substantial positions in your portfolio. I think that all of us should have some gold until the day that, you know, we're put on the raft to Valhalla. But for a larger position in your portfolio, I think you should regard it as a rentable commodity. So you basically hold it, and the point at which you sell it should be when there's a great deal of hysteria around, when everyone wants to, like Bitcoin when it was at $60,000, and everyone in the world, including Uber drivers, were buying Bitcoin. That was the time to sell it. I think the same will apply to gold. And if you've got an instinct for selling, then you'll know the point at which to sell it. And even if it goes up another 10, 20 or 30%, if you've made 50% or you've doubled your money in it, whatever it is, you can be happy. Don't be tempted when it is at peak hysteria to go back in. So when it's at peak hysteria, it's probably going to go down. I mean, I can see some things out there now that represent peak hysteria. Tesla is a very good example of that. I think Apple is another good example of that. The big tech companies, they are going ex-growth in many cases, and they are far too expensive. I don't think it's the case in gold. There's a lot of pessimism around rising interest rates. I read all these reports from UBS and HSBC and so forth. And, although I like to read them, I think most of the people who write them have absolutely no idea what make markets work. They've been in the markets 5 or 10 years as analysts, and they just don't know that, they are just putting a finger in the air. And so what we need to do is to judge that moment. And I can tell you from a master investor point of view, if I feel that gold is too high or too, hysterical, I will I'll make a commitment. I'll put out a piece for master investor viewers that they can either follow or not. But, based on my judgment and what I will do, which is, will I sell my position at that point? And the answer is yes. And, I think you just play the hysteria as much as you can. And hysteria is going to come. It's as sure as the world turns that there will be a huge upsurge in the gold price in the relatively near future. So you better be prepared.
Gosh, I think we have to be prepared for redundancies for many gold analysts within the city after that. Sticking fingers in there. But earlier on, you were suggesting that possibly the gold price has been suppressed. So an anonymous attendee says, in the near future, could you see an alternative BRICS-based gold standard arising in direct competition with the allegedly suppressed LBMA and COMEX paper markets, such that true price discovery for physical gold could finally be forced?
Well, that's possible, but I don't think it'll be BRICS-based. I think it will be a China-led sort of system, probably. And but I think we're looking at 10, 20 years out. And at the moment, the fiat currency of note, of course, is the US dollar, and it will remain that for some time. That having been said, 2 key events have occurred. One is that there's been a confiscation of half of Russia's foreign exchange reserves, and I don't think that's a bad thing. But on the other hand, if you were a regime or you were a country with substantial foreign exchange reserves, such as, for instance, Saudi Arabia or China, and you would be looking at that thinking, should I have so much money in US dollars and US treasuries and so forth that they can be confiscated? Where am I going to put my money where I feel that there's a greater confidence level in terms of that if I do something that might upset the US or the international community, I can keep my money. And gold is definitely one of those key elements. So I feel that the central banks of the world, and they are, by the way, are increasing their allocation to gold. So the question is, where are the sellers coming from? And that relates back to possible suppression of prices. And the second key event is the demand by China and Russia to be paid for their commodities, or to pay for commodities and to be paid for their output in non-US dollar currencies, and gold is a currency, of course. And that, I think, is long-term very positive for the gold price. We're not finding, the world is not finding a lot more gold. In fact, I don't think that mine discoveries and production are keeping pace with demand increases, and they haven't been for a while, although for the previous century, there's been a 1.8% average annual increase in mine production. That's now come to an end because the serious discoveries are just not happening on a scale necessary to replenish demand. And the recycling of jewelry, which is the most significant element of recycling, it's about 90% of recycling in gold, is also diminishing. And the capture of gold from electronics, which is about 10% of recycling, is fairly static. So the fundamental elements driving gold physical demand, which ultimately will prevail in terms of gold paper demand, are positive. But if you're a gold investor, I mean, I think there are some people who are like stop clocks, right? Twice a day, the clock will get to your level and the price of gold will go up and you'll look fantastic as a permanent gold buck. But just remember, we're in a cycle here. We're in the beginning of, I think, a major upcycle in gold, but when it gets hysterical, make sure you get out.
Which brings me to a factoid that I've gleaned from the US Geological Survey. It says about 244,000 metric tons of gold has been discovered to date. That's just discovered, not extracted. All the gold discovered so far would fit in a cube that is 23 meters wide on every side. Actually, that's not a lot.
Well, it's a lot if you own it. Yeah, I mean, obviously, that's one of the reasons why gold is so attractive, is its scarcity value. They talk in Bitcoin, they talk about its scarcity value as the number of Bitcoins that can be mined goes down year after year until eventually there are no more being mined. But frankly speaking, with Bitcoins being stolen left, right, and center, or being lost, or all the problems in using Bitcoins, why wouldn't you want to own gold, which is an established store of value over centuries? And even if there's a lot of price volatility and uncertainty as to when it's going to take off or not take off, I think I would much prefer to own gold and silver than a cryptocurrency fundamentally. And good luck to those who are crypto maniacs, but I'm not one of them.
Final question is from Chris, who says, for its easier and cheaper security, what are your views on holding unallocated gold?
I have no idea what he means by unallocated gold, but I'm sure he knows more about it than I do. But I guess that is sort of, the gold-backed bits of paper with no specific gold that's attached to those bits of paper, a bit like the tethered Bitcoins. You remember the ones that were related, you were kind of stable coins that called they're linked to the dollar. Look what happened to those. I just want to know where my gold is. So I would go for an established large ETF provided by a financially solid provider. If you're going to go for ETFs, I would not, as I said earlier, go for the leverage ones. It's just too dangerous. And then I'd look for gold mines. And the great thing about gold mines is that, if you look at all-in price of production of, let's say, $1,000 an ounce, and the gold price goes to, hypothetically to $3,000, $4,000, $5,000 an ounce, those companies will be making super large profits. A bit like BP and Shell were making super large profits a few months back. It'll be the same in gold. And one of the great things about gold companies is I very much doubt that windfall profit taxes will be applied to them.
And Chris has just qualified. He says he's talking about Perth Mint issue certificates when he was talking about unallocated gold. But there you go, Jim.
Well, there's a scandal in the Perth Mint at the moment. There's the Australian financial regulators are looking into it. So, Chris, when you get off the plane in Perth, I mean, this is not a universal statement, but the stench of corruption is in the air as you walk down the steps. So be very careful.
Thank you very much. Well, Jim, you're a forever friend to Master Investor. I think you are now a foe of all the gold analysts in the city who are now
not all of them.
Waiting for their P45. So thank you very much indeed. It's been absolute. We never have enough time, but do take care, and everyone's quickly going to be looking at their Perth Mint certificates. Thank you.
Yeah, love talking to you, Sarah. Thank you so much. Thank you. Thanks.
Thank you. And thank you for all your questions. Right then, do you want to buy, save, send and spend real gold and other currencies digitally? Our next company can help you do just that. It's called Glint, and this is the company that has the who's who of the Gold Council on its board. That is amazing in itself. I'm joined by the amazing founder and chief executive, Jason Cousins. So Jason, you have 15 minutes to tell us about your company and its offering and how on earth you got that quality of personnel onto your board.
Thank you very much. I really appreciate it, Sarah, being on the show today. And I'm just going to share my screen so I can, at the risk of killing everybody with PowerPoint, I'll try not to do that. I've got some slides to kind of go with what I'm saying. I'll try and be as quick as I can. So, for me, really, the big question began for me in the realization of some of the problems in the world in 2008 in the global financial crisis. It was the first time that I realized that your money in the bank, your hard-earned savings in that bank it's not a risk-free deposit of funds. When you put your money in the bank, of course, it ceases to be yours. They lend it out, and it is put at risk fundamentally. And at that moment, I started thinking about, well, what is a good way to be able to store my hard-earned wealth, and is there a way to be able to keep my ready money as well, which can be significant, safe from any risk within the financial system? And I actually wasn't from within financial services. I was trained as an architect, and I'd been developing actually virtual buildings, so to speak, websites, e-commerce systems, and stuff like that up until this point. And I started looking for maybe what the alternative was. And of course, I learned about gold. I didn't go down the cryptocurrency route. I discovered that, gold is the ultimate store of value. In the last 50 years since I was born, the US dollar and the pound had lost more than 85% of their purchasing power, and that the gold's purchasing power actually had increased by over 500%. I started thinking about, why is it that a burger used to cost 55 cents now costs $4, and in LA it's $15? Has the burger got bigger? No. The value of the currency has become less. And I know all of you out there probably understand this adequately, but for me, it was a journey. And I thought, well, hang on, that if this gold is, it still buys you what it did 2,000 years ago, never mind 50. It's the ultimate, as I said, store of value, but its medium of exchange, of course, had stopped in 1971 when Nixon very kindly took us off temporarily off the gold standard, of course. And since then, of course, as Jim has said on many occasions, the amount of the debasement in the currencies has just accelerated hugely. And so therefore has the debasement of the purchasing power, and the trust that we have in fiat currencies has declined. The trust in the banking system since 2008 has declined. And people have started looking for an alternative. Of course, some people looked at cryptocurrencies, but there has been this big resurgence in interest in gold. The question, of course, is gold money? Is it simply a commodity? Is it still a valid reserve asset? Is it a good portfolio diversifier? Is it a speculative asset? Is it an effective inflation hedge? But what I decided to do is to say, okay, well, gold's this rare, durable, and fungible store of value. How can we allow it to re-participate in electronic payments like it did before we came off the gold standard in 1971? How can we enable gold to be used when you pop down to the supermarket to buy your croissants in the morning? We believe that gold is that possible solution to restoring trust in the system through sound money. And so we've built technology to enable that to happen. But crucially, we do believe in choice as well, because as it's been discussed, and Jim said, it's not the perfect solution in a world which is priced in fiat currencies. So the problems we're facing: rising inflation, risk within the banking system, The fact that gold's not a great medium of exchange at the moment. Cryptocurrencies, of course, as Jim has said, are risk on and unproven. So when Russia invaded Ukraine, of course, stocks and cryptos dropped, but of course, gold and the US dollar strengthened. And we remain with other problems as well, such as the international payments system remains inefficient for most people. So what Glint has done, it's a gold-fi fintech, probably the best way to describe it. It's a kind of hybrid between a payments and a trading platform. And we're the first company in the world to enable physical gold, real allocated gold. So going back to that question about unallocated, this is real solid gold bars that our customers own. It's not owned by us. They're in a vault in Switzerland, run by Brinks and insured by Lloyd's of London. So there's no lending out of the gold as you would get with unallocated gold. There's no company sitting between you and your ownership of your gold legally. There's no share fund that exists between you and your gold as you'd have in an ETF. But yeah, with this, you can buy gold very cheaply. I mean, you can buy it in small denominations. So we want to democratize access to gold. So you can buy, 1 penny or 1 cent's worth of the gold bar that's sat in Switzerland, or millions of dollars if that's what you want to do or have the funds to do. You can, of course, save that gold. You can put your ready money into this because you can spend it at a moment's notice. So literally with my app, I've got my expense account here. If I look into it, you can see the app here. Maybe in the small thumbnail, but you can see that I use it to buy, my breakfast at Pret a Manger with 0.32 grams of gold. And I also use it to buy my flight to New York last week. That's 64 grams of gold. Anywhere in the world where MasterCard's accepted, we can now use gold as money, effectively putting you all onto your own personal gold standard. And yes, gold doesn't give you a yield. In the same way, I'd say that fiat currencies don't give a yield if they're put in the vault as well. Of course, we can use our gold to invest in businesses. We can use the card to fund our investment accounts if that's what we want to do. But it is a very reliable form of money, and our customers are coming to us in droves because of the uncertainty that's out there in the world. Apart from being able to buy, save, and spend your gold with the MasterCard, you can also send it to each other outside of the banking system from one account to another. So I'll talk a little bit more about that later. But Glint is currently obviously thriving in the worsening economic climate. Something though, I wish we didn't have to, it wasn't the situation. I wish for my children and my grandchildren, the world was a better place, but hopefully we're offering a glint of hope for people out there. So Glint is, as I said, we want to offer choice. So it's multi-currency. The account has a US dollar, a euro, a pound, and a gold wallet. So 4 different wallets in there, and you can move very quickly between them. We've got plans to include Japanese yen, which has been talked about today, CAD dollar, Swiss franc, etc., up to 17 different currencies eventually. Of course, you can spend, as I said, these currencies in 150 different currencies around the world using the real exchange rate, so not the one the bank might give you or the bureau de change at the airport. And we only charge a very small 0.5% fee. Just on the subject of fees, we only charge 0.02% a month. That's, I think, 0.24% a year. To have your gold stored and insured so that no one comes along with a metal detector as Jim fears trying to find your gold. It's all safe and out of the way and secure. We're regulated and a multinational business. We're headquartered in London. We've got teams also in the US and even in Japan. And we're regulated by the Financial Conduct Authority. So as a business, that's a kind of a level of assurance that we can give our customers that even though the FCA doesn't effectively regulate gold, they regulate us as a business, the funds coming into our business, what we call e-money. And we have the gold audited with an independent auditor on a regular basis. So we're also able to issue these Glint MasterCards. Even though our account is available in 200 countries, you can issue the Glint MasterCard in the UK, in Europe, and in the USA. And we're partnered with MasterCard, as I said, Brinks, Lloyd's Bank, and Sutton Bank in the USA. The app, I encourage you just to download it. It's free to download. It's free to join. It only takes a few minutes to download, to register. Most people are approved very quickly. In fact, instantly. I think 60 to 70% are approved automatically through the data that we collate during our KYC process. So please just go to your app store and check it out. We're backed by some fantastic investors. We're very fortunate to have Sprott, who you might know as one of the biggest asset managers in the world focused on gold. They no longer have 16 billion under management. I think it's more like 28 actually. The Tokyo Commodity Exchange, who have never invested in a business before or since, but they believe that Glint is going to grow the size of the gold market. Sibanye-Stillwater, their Bio Cube Innovation Fund had invested in Glint in January. They're a fantastic business, which is backing Glint, and of course the British Business Bank with their Future Fund, and lots of other interesting people. Craig Dewar, for instance, he is the founder of a company called Global Processing Services, which powers all of the big neobanks, Revoluts, the Starlings, the Monzos, and the Curves. The kind of the founding father of British fintech. Very happy to have him as an investor. He thinks what we've built from a regulatory and technical perspective is fantastic. As well as people like Nicholas Silich in the US, who's the head of risk Prudential Life Insurance. And his analysts, the way they look at the world going forward, he thinks Glint is the perfect solution as we really go through a kind of paradigm shift, I think, in how people look at money and how they look at investments. And he thinks that we're going to be the kind of perfect fintech business to be coming out the other side, a new model really, as well as Sir Peter Michael, who's a fintech entrepreneur in his own right, going back to the heady early days of emergence of Silicon Valley. The company itself is doing very well. Our growth is expanding. We're expanding very quickly. Last quarter, we had 130% growth in both the number of clients we had and the amount of revenue we're making. We started making revenues at the beginning of the year. We're nearly at $2 million annual run rate revenue, and we expect to get to $16 million next year. And our customers are, basically, although we have this idea that and belief that everyone should have an equal opportunity to prosper, and there's a level of democratization to the product, there's an obviously strong product market fit with money. And so our clients represent probably the top 5% wealthiest people in the UK and the US, as Experian discovered when they did an analysis of our customer base. Anyway, just before I finish, just a few things about the new exciting products we've got. The features and the new products we've got in the platform. We've just launched an advisor portal for wealth managers, and this allows them to buy allocated gold, because as one of the listeners has pointed out, most of the advisors, wealth managers at the moment only give exposure to what I call unallocated gold. With Glint, they can actually buy real allocated gold and also give unprecedented liquidity to their portfolio by effectively the card and the app being able to give their customers access to their gold proportion of their portfolio, whether it's 5 or 10%. With the card, they can spend it when they want to, and the advisor can just rebalance their portfolio the next time they do that balancing act. We've got tiered subscriptions coming in later in the year, which give an annuity to us, a SaaS model where customers will be paying us on a monthly basis to have access to the account and get access to extra benefits. Our peer-to-peer system really is a Trojan horse, as I call it, behind the scenes. It's the beginnings of this global international payments platform based on gold. And we'll soon be launching gold dividends. So gold mining companies will be able to pay those dividends into your Glint account in gold. We're building a crypto bridge so that people within the cryptocurrency movement can move their positive gains into gold and vice versa when that's needed. We're working with Sibanye-Stillwater on developing ESG initiatives to get defined sustainably mined gold into the hands of our customers, and also be launching business accounts next year. So effectively what we have is the opportunity and we have the capability to build a global financial system based on gold. And that's going to be covering payments, it's going to become pension schemes, account schemes, banking systems, being involved in cryptocurrency exchanges, an international system. That's the opportunity for Glint and for the world. It's a really huge one. The size of the market is enormous. I just say we own our own technology. So unlike a lot of the fintechs out there, we've built our own platform. We had to. There was no company in the world that enabled gold as money. So we had to build that technology ourselves. And as has been said, we're very privileged to have a fantastic board of directors that make sure and look after the interests of shareholders. So Haruko Fukuda, she was the former CEO of the World Gold Council. Marcus Grubb was the head of investments there before moving into the Platinum Council. Oliver Balaithos, for former Goldman Sachs head of asset management for Asia, and Laurent Chabanier, very pleased to have him join the board since the Sabania investment. He's the chief commercial and development officer at Sabania. We have a fantastic team, and I just again, I'd encourage you all to download the app, whether it's on the Google Play Store or the Apple App Store. And also, if you're interested actually investing in Glint, the company, not just gold, I hear that during the great gold rush, it was the people who provided the axes and the picks that did better than most of the prospectors. If you want to invest in Glint, the company, we will be launching a crowdfunding campaign as we did last year. We were very privileged to get 1,200 people become investors in the company. A lot of them are clients. We'll be offering that again to our enlarged customer base. We now have 150,000 registered users on the Glint platform. And you can go to invest.glintpay.com. That's invest.glintpay.com if you're interested in making sure you're on the priority list for that.
Many thanks, Jason. That's a lot to consider. I like the way that you've put Pret-a-Manger on its own gold standard as you pay for your coffees using your Glint Pay app. And I heard what you said, offering a glint of hope for the generations to follow. And of course, us now. So now we have lots of questions. Merlene asks, with Glint, is your top-up funds safe from a bank crash in the UK? Not that we're anticipating one, but just in case.
Well, of course, I would advocate always that you try and move your money into gold as quickly as possible. But we've done our best to make sure that the fiat currency in your accounts is as safe as it can be. They're in segregated and safeguarded accounts. So in theory, the bank can't lend that money out and be free from the contagion that might be involved in there. However, it's never been tested. So we've done the best we can. As I said, I would recommend that it goes into gold because that is no one else's liability. That is your gold.
At this stage of your development, Alex asks, is Glint just for gold or other precious metals and commodities?
Yeah, a lot of our customers would like us to, for instance, put silver onto the platform. Well, Platinum Council asked us to put platinum on, but we have a philosophical belief that gold is the ultimate form of money. It isn't, it's created when two neutron stars collide. One of the reasons why it can't be corrupted, and it can't fade. It can't corrupt. It doesn't rust. It doesn't go off like silver does, for instance. And we believe fundamentally that ultimately silver was introduced because gold became so expensive, and you couldn't exactly shave off a tiny bit of gold to pay for a potato back in the day. We've enabled the fractionalization of the gold down to, as I said, a penny's worth. So we don't think there's a need to do that. However, I don't rule it out for the future.
Alex asks, if the gold price goes up, are you liable for capital gains tax on your Glint balance?
Yeah, well, it depends what country you're in. Of course, in the UK, yes, you are. If you're lucky enough to have a gain, which you do have more often than not with gold, of course, you are liable for capital gains tax. We have in the system, you can download spreadsheets and PDFs of all your transactions. And actually, we now have a partnership with KPMG, which at the moment you have to do offline. You can request a tax statement from depending on the country you're in, which will give everything all sorted out for you. And that will be in the app, probably about Q2 of next year.
Now, you're talking about expansion, ambition and development, but Alex brings us back down to reality. He says, if Glint fails as a business, what happens to my gold?
Well, it's a good question, actually. Back in 2019, believe it or not, our little company was subject to a hostile takeover attack. And it's a very long story, and the script probably worthy of the next series of Startup on Netflix, season 4. But to cut a long story short, Our UK company was actually put into administration for 7 weeks, and it was very unfortunate. It was something that we battled through, and within 7 weeks we got out of administration. We're probably the only one of the few companies that ever got out of administration in the UK solvently, and of course we did that because we disputed the administration. We don't think it should ever happen. But more importantly, the forensic audits on all of the gold and all of the pounds and dollars and euros in the account came back to show that our systems and processes were totally safe, and all that gold was protected from the administrators as well. It is your gold. It is not ours.
Okay, so good to know that you can safeguard our gold, because of course you have democratized gold for us. Can I redeem my Glint physical gold?
You can. It's a bit of a pain, to be honest. At the moment, it's not inside the app, and our client services team, a little bit frustrated by the fact that that's not in the app. But if you can request from client services that you have your gold delivered, and of course you can. If you don't have a kilo's worth, for instance, which might be stored in the vault, that's easy. That's just a delivery of that kilo to you. If you have a small denomination, we can also supply different formats of gold and different sizes and a bar to you with a small admin fee and delivery fee.
Okay, in terms of fees, there are lots of potential customers out there. Many are asking, what are Glint fees and limits?
Yeah, so we charge 0.5% when you buy your gold. Importantly, when you spend it, which if you think about it is a sale of your gold into the currency of the merchant, we don't charge you anything. So actually the round trip is only 0.5%. And why would we do that? Well, we actually get, for instance, outside of the UK, 1% from the merchant themselves. If you choose to sell your gold into fiat currency, we do charge you 0.5%. If you it's free to withdraw. We only charge you 0.02% a month to have that gold stored and insured by Lloyd's of London. I think there's a £7.50 price cost to have your card delivered to you. But yeah, we're trying to use the efficiencies of technology to be able to pass on those efficiencies in terms of low pricing to our customers and make sure that there's as little friction as possible for using gold as money.
Okay, Alex is just doing a follow-up on the capital gains tax. This will be the last question. He says, thanks, just a follow-up on the capital gains tax. Would the liability be at the point of spending the gold, i.e. the point when it is converted from gold to UK pound sterling?
Well, of course, I can't give financial advice. Yes, up to your accountant. I have my own personal views about capital gains tax, actually. Personally, I don't think that it should be available. They should not be charging capital gains when it comes to spending your gold. In the same way, you don't pay capital gains when you are spending your foreign currencies, when you're traveling around the world and come back to find that the dollar has strengthened, for instance, you've had a gain. You don't pay capital gains when that happens. So that's my view. HMRC won't comment on that, of course. We'll have to see. But as I said, we have the data and information for you to be able to easily deal with that if that's the case.
Okay, because we don't want this webinar filled with attrition. We've already upset the gold analysts in the city. We don't want to be upsetting HMRC, but for those of us who are keen to download the app, I'm assuming it's the usual platforms, app stores. Is it Google Play?
Yes, Google Play and Apple Pay, and you can download the Glint app. Look for Glint or Glint Pay. I'm sure you'll find it very easy to find. Download it. I think we've had the last time I looked, we had 1,500 people that all give us very positive reviews. I think the majority of them are 5-star reviews. If you've got any ideas that you want to pass us, then do send them in. Any feedback, always very happy to listen. At the end of the day, our customers are the best thing about Glint.
Many thanks. Jason Cousins, Chief Executive and Founder of Glint. Thank you very much for putting us all on the gold standard. Thank you very much indeed.
Thank you. Thank you.
Thank you. And thanks for the great questions. That was fascinating, just as our next presentation will be. It's Barton Gold now, because the Western gold fields of Australia are overcrowded. And that's an area our next company is avoiding because it has its own 1 million ounce platform in the south that it's developing for long-term value. It's ASX listed Barton Gold, and the Managing Director, Chief Executive is Alex Scanlon, who joins us now. A very warm welcome to you.
Thank you very much, Sarah. It's a pleasure to join you today, and I think there's been some very good questions posed. Just by way of quick introduction, my own background is as a structured financier, a macroeconomist, and a principal investor in the resources sector. So a lot of the things that I've looked at traditionally go back to some of these large-scale macro drivers that people are asking questions about, and which Jason and Jim have both addressed. In that context, and thinking about who we are, what was our purpose, and from where was Barton Gold born, we were looking around in 2016 and 17, and looking at a world with let's just say an increasingly dangerous geopolitical risk profile, and one where we'd been watching really excessive central bank monetary policy issuance since the outset of the GFC. And we're really looking forward to a world that we thought would have really sustained and significant inflation. So we were looking around, obviously Australia is a well-known jurisdiction, and I happen to live in Australia. So it's pretty easy to join the dots and say, look, it's time to start looking for gold, and in a tier 1 jurisdiction, Australia being one of those. And we were looking in a number of different areas in Australia, but we settled on South Australia. And the reason for South Australia, and the reason that Barton Gold is exclusively focused on South Australia, is that South Australia is actually extremely well endowed in terms of gold. It's very well represented in terms of Australia's gold resources. It's got about 25% of Australia's known gold mineral resources, but it's very underrepresented, I should say, in terms of production. So only about 2.5% of Australia's gold production comes from South Australia. And this is really a legacy of a 30-year period of time of very significant underinvestment in South Australia, despite a preceding 100-year history, which has been potted with some very interesting gold development. So what we've done is we've gone and we've actually built a strategic platform based in the Central Gawler Craton in South Australia. We did a lot of work before we IPO'd. We have essentially listed a 1.1 million ounce gold platform with the benefit of the only gold mill in the region. So in many ways, who we are, what we are, we're long-term strategic asset explorers and developers, but we're sort of starting with a platform, which is usually sort of the end goal, getting to that 1 million ounce in a development basis to build a mill. That's usually the end goal of many explorers. That's very much our starting position. And we believe this gives us a very significant opportunity. One, I'll share some information with you. We believe we're in an excellent position to develop a multi-million ounce platform. We believe that we're in a good position to build South Australia's leading independent gold producer, which would be north of 150,000 ounces per annum, and really also to establish long-term leadership in this region. We have a very clear focus and strategy. We're very well capitalized. We have $11.2 million in cash as of the 30th of June. And we also have excellent operational and leadership teams. What we're really doing with our strategy is targeting scale. With scale comes both efficiency and optionality. So what we're really looking is leveraging the foundations, what we've got. In the Southern Hub, when we look at our projects, we have 3 projects. Our Southern Hub, which are our Tarcoola and Tunkillia projects, we are looking to leverage these for large-scale resources growth. There's a couple of reasons for this. These are 2,500 square kilometers of large-scale ground, where there are over 100 kilometers of untested shear systems. We have an existing approximate 1 million ounce resource platform there, and the focus really is on open pitable large-scale mineralization. We also have what we call in our Northern Hub some joint venture gold interests. We're the minority owner of about 300,000 ounces. That importantly sits within about 40 kilometers of our gold mill. And that gold mill is wholly owned. It's the only gold mill in the region, and we're surrounded by an increasing number of junior and emerging explorers who will need somewhere to process their gold. In terms of what we've done with all of this, we're starting to now really build momentum. So we listed last June, June 2021. We're applying a lot of new technology. One of the challenges of exploring in South Australia is you tend to be exploring undercover. So we're actually adopting a lot of existing and new technologies from areas where they've been used in more predominantly outcropping jurisdictions to South Australia. And we've also been leveraging our existing asset platform. And what that means is, one, we're accelerating exploration in an area that's kind of been overlooked and left behind. And two, we're also taking our existing asset platform, we're monetizing it, we're extracting value from it. And that generates some income for us and actually offsets our expenditure. And of course is sort of a protective action or preemptive protective measures that we take for our shareholders, because it means that we don't have to go sort of systematically or sequentially back to the market every couple of months to raise another few $1 million. What have we done with this? We've actually had pretty extensive early success. We've identified 4 new gold zones since we IPO'd last year. So that's identified about 2 kilometers of new mineralization. We've had over $2 million of income since IPO, almost $1 million in grants from the South Australian government. They're very strong supporters of us. And we've also built a very significant and experienced new leadership team based in Adelaide from our new headquarters. So we're essentially laying the foundations for large-scale gold development and long-term leadership in that Gawler Craton. Just a quick snapshot at sort of the capital component of the company, and this is both the financial capital as well as the human capital. We have a fairly tight share register, very strong alignment between the board and management and the shareholders. So the company's about 1/3 owned by board and management. As I mentioned before, we've got $11.2 million in cash, so we're very, very well capitalized, and from an enterprise value perspective, quite cheap. Importantly, I'll sort of turn to our board of directors and our management and technical team. We have a very broadly and deeply experienced board and management team, experienced in all respects of mineral exploration, development, financing, operations, and processing. And that really reflects the fact that we are not just an explorer, but really our sort of forward ambition to move through all of these successive stages quite successfully. We have a lot of gold experience, a lot of South Australia experience, and a lot of development finance experience. So stepping into the assets now, we'll start with the Tarcoola project. You'll recall this was the sort of the project in the middle, or in the northern part of the southern hub. This is an area that has been the subject of a number of sort of rushes of interest in Australia, but really kind of forgotten about since the mid to late 1990s, when the gold price dropped precipitously. And what we've got here is about 1,200 square kilometers of tenements. We have a fully permitted mining lease, which was actually the home of the South Australian gold rush in the late 1800s. So during the early 1900s, the old timers, if you will, were sort of taking gold out, chiseling gold out with picks and axes by hand. And they produced about 77,000 ounces of gold just from a series of shallow veins across our tenement, which is not an altogether large volume of material, but at 37.5 grams per ton, it becomes pretty interesting. And that was also recently producing during 2018, that tenement sent ore from our Perseverance open pit mine, which you can see in the inset there, at about 3.8 grams per ton to our mill. There are a number of open pit extensions and local targets on that mining lease, but we've also identified a much larger system of repeating shears across just that western margin of the exploration license. So really what we're focused on is building out across that and basically creating multiple open pitable targets. When we sort of zoom in on the pit, if you will, just by way of example of why this is exciting, we acquired this pit in early 2019. There's very little drilling around the pit. We've come in, we've drilled it, we've since mapped over 200-meter depth extensions below this pit, and we've actually identified an entirely new gold zone adjacent to the pit, or as essentially a southwest extension of the pit, which we've called Perseverance West. And this Perseverance West zone is essentially a second set of high-grade structures that are intercepting a number of interesting features, which have fed the richest grades of that pit. But what you can see both in the area below the pit and along strike of the pit, we've had some intercepts with some very, very interesting gold hits, both broad and high-grade mineralization. So what we're looking to do, and really looking to the big picture, is focus on the big picture. Where we have that Perseverance mine, that historical high-grade pit there, We've identified a number of target structures, both across that existing mining lease, but also regionally, about 14 kilometers to the west, where we found a series of parallel and cross-cutting major shear structures, which are analogous and virtually identical to the Perseverance shear, which created that high-grade pit. And so now what we're looking at doing and working at doing is systematically focusing in on and zeroing in on our high priority targets there. We're going to be doing some new seismic work later this year to try to tie this all together. And then during 2023, we expect to be able to sort of go through a buffet of exploration targets where we've precisely modeled the underground structure, and we can test that efficiently without excessive drilling. One target, as an example, is the Warburton target that sits about 5 to 8 kilometers west of our mining lease, depending on which end of the mining lease you're on. And this is a target that AngloGold did some drilling on in 1997. They drilled 16 meters at about 3.5 grams per ton, essentially from surface, and didn't follow it up. And the question we often get is, why would they not have followed that up? In September of 1997, the US dollar gold price was $325 and falling. So not something that was a needle mover at that time. And a lot of people essentially pulled off of gold investment and essentially vacated South Australia, leaving these opportunities for us. So what we're looking at here is creating a series of potentially shallow, high grade, repeating open pits. And that would be awfully nice if we could match that with some very large scale baseload mineralization. Now, this is where we then look to our Tunkillia project. And again, for perspective, we're now about 70 kilometers south of the Tarcoola project. We've got about 50 kilometers of continuous shear zones. These are major shear zones on our tenements there. And we're really focused on is in the northwest portion of this project. That's the 223 deposit as our cornerstone there. It's about 2.5 kilometers long. It's open to strike and depth. It's got about 965,000 ounces in it. And we've also identified I should say, confirmed our thesis for a higher grade central zone inside of that deposit, which really improves the development proposition. We have now, in the time since IPO, tested a number of theses. We've actually identified 3 new gold zones, all in the vicinity of this 223 deposit. So that's added 2.3 kilometers of new mineralization and really demonstrated that the gold endowment here is substantially larger than historically understood. So when we look at, what does that mean? The project area itself is expanding rapidly. So we're essentially establishing a significantly expanded footprint. We're setting the foundation for major growth. Historically speaking, the gold endowment here was recognized to be around 500,000 ounces. We actually increased that to 965,000 ounces before our IPO. The 3 new gold zones, which are the 223 North, the Area 191 and Area 51 gold zones, have added about 2 kilometers of mineralization to this 2.5 kilometer long deposit. And what they really do importantly is demonstrate that the footprint of mineralization there is considerably larger than previously understood. So we think there's both significant potential in that 223 deposit, but also for growth in resources in and around and growing from these new zones of mineralization. We also then look down the shear zone. So again, we're really looking only at a small portion of our project area. That project area that we're looking at is circled there in yellow on this broader regional map. And we have now essentially demonstrated very well that the gold endowment in this Yarborough shear zone is quite substantial and larger than previously understood. That 223 deposit is surrounded by a number of satellites, but that's really only limited to the very northern portion of this area. And importantly, we had some new geophysical predictive models, which actually did predict mineralization at the 223 North, Area 191 and Area 51 targets. So that same model that we have drill validated is actually predicting extensions of that mineralization to the south. So we're looking to apply new technologies and methodologies and actually look to extend the gold mineralization considerably down the next 5, 10, 15, and potentially 20 kilometers of the shear zone. And the key message here is, what we've identified is that there is a potentially substantial gold neighborhood here, and we already have an existing 1 million ounce residence there. So we think there's a tremendous amount of upside. So looking forward, tying this all together, what is our ambition here? What are we looking to do? What is our development pathway? We've already got a very solid platform, and we are growing it. Our ambition is to take our total resources to north of 2 million ounces. as a starting platform to develop South Australia's largest independent gold producer, which would see us producing north of 150,000 ounces per annum of gold. And we're hoping to do that within 5 years. Now, importantly, because of our infrastructure position, we have a lot of optionality here, and we can actually divide our sort of development thinking into stages. Stage 2 is really that longer term 5-year, everything's functioning and firing and continuing to grow mission. But we have the opportunity from within this to bring forward stage 1 development and operations. And that is really using our existing mill and our existing permitted mining leases, both at Tarcoola and at Challenger. This is essentially a combination of fully permitted, fully licensed mining leases and proven infrastructure, logistics, and metallurgy. So that's a very, very strong opportunity for us to essentially bring forward cash flows and operations and essentially change our profile as a company, both from the market's perspective, but also from the financing, bank financing perspective, from explorer to developer and producer, and to a cash flowing business with valuable yielding infrastructure. And that'll put us in a much better position to then extend into stage 2 development of another mill down near Tunkillia. We also have a number of options to accelerate our stage 1 operations, and that relates primarily to one existing mineralization in the region. As I mentioned before, we are the minority interest in about 320,000 ounces of gold, which is about 40 kilometers from the mill. But there are a number of other projects as well, which are sort of emerging in the region that have some very interesting mineralization and could put some real marginal gold ounces within trucking distance of the mill. So, in summary, we're quite a unique platform. On the ASX, we are the only pure play South Australian, pure play gold focused explorer developer with a very experienced leadership team. As I mentioned, we do have an existing platform, existing infrastructure. We are growing rapidly, and we've got a very strong pathway for development, including using existing mining leases. So being well capitalized to do that, this is a time in the market where a lot of things are oversold. We have the ability to continue working through and playing through that. And that really means doing a lot of work, which is driving a lot of upcoming catalysts, including the exploration results and mineral resource update that will follow our current 9,000 meter program at Tunkillia, which has followed up our latest discovery at Area 51. And really, if if this is a proposition that you think is interesting, our proposal is that it is actually quite a deep value proposition. So as a market participant, we obviously track ourselves and compare ourselves against our peers. We're quite restrictive and quite critical of comparable companies' analysis. And we have a very restrictive set of criteria. And these are ASX listed, Australian domiciled, large scale continuous open pit mineralization that is also sub 1.3 gram per ton. And when you look at the participants in the market who fit that restrictive set of criteria, there are only essentially 6 listed companies, of which we are one. The rest are based in Western Australia. We're the only South Australian representative opportunity in the market. We're actually valued at about 25% of our peers on an enterprise value to resource basis. This is really sort of a lack of awareness of the South Australia story that we are working now on sharing and getting out there. And notably, in this group of peers, we're the only mill owner. So we're the only ones who can sort of do what I refer to as crossing the capital drawbridge. We can decide to turn on our operations and do it at relatively limited cost, whereas most of our peers, most developers in the market, need to spend 100 or 200 to 300, sometimes more $1 million to develop a plant. That's not necessarily a problem for us. So we believe we're well positioned, certainly to outperform relative to our peers. And we have a number of major catalysts coming up, including further gold and asset sales, exploration work, and of course, a significant mineral resources update following our current drilling work.
Many thanks. Thank you, Alex. Many thanks indeed. And I hadn't appreciated that you are, in fact, the founder as well. And certainly, 5 years will fly by. An awful lot to achieve. Now, right at the beginning, you talked about the historical underinvestment in Southern Australia, and it looks as though it's actually benefited you because you're the recipient of $1 million grants and not loans. So you're not having to give that money back to the government. So I'm just wondering if you are now resetting perceptions about the potential in southern Australia, and whether the historical underinvestment is now being reset by your work there.
Yeah, look, certainly there's been an increase in awareness. Since we've gone in there, what we've seen is a number of explorers coming in and taking positions around us, if you will. It's quite common, obviously, if you're an ambitious explorer or developer, if you can establish a position and build a relationship with somebody who has a mill, that is a very interesting opportunity to potentially get your assets into development without having to bear the burden of that capital drawbridge. What I would say as well, and really following from your question, is that the South Australian government has really taken a very specific focus on improving its profile. So the Gawler Creighton is globally recognized as a globally renowned district. I mean, this is the home of Olympic Dam and Carrapateena and Prominent Hill, and these are all 150 kilometers east of us in the IOCG belt. And it is, where we are, has had a number of operating gold mines in the past, but the government really hasn't had an opportunity to rally around a consistent thesis. And we're very fortunate that we found that they've been excellent supporters of us. They have given us nearly $1 million in grants to actually directly subsidize our exploration. And I think what we will see is that over time, there will be continued growth and interest in this area. But as you mentioned, as you quite rightly pointed out, there are very few places where you can establish a strategic footprint like this and essentially take over the majority of these, historical significant gold producing and exploring ground kind of in one shot before everyone realizes what is going on. So that's definitely central to our strategy.
Okay, you've got the majority, but not all, because you talked about the appearance of more and more junior gold explorers. It's great for your toll mill, but it's competition for the licenses. So perhaps you don't want it to get too busy, that district.
Well, look, competition for licenses is not necessarily a restrictive issue. The South Australian government would like to see these many potential emerging projects go into operation. So I don't think it's going to be a shortage of license availability from that perspective. Certainly right now we have a fairly significant advantage in having the only mill in the region, and we propose to have the only two in the region. And that gives us an opportunity to really establish long-term leadership there when it comes to gold processing and production.
Okay, final question. 11.2 million, I think you've got as of June. Obviously, I'd love it in my bank account, but it's not a lot for what you want to achieve in the next 5 years. So in terms of financing, how creative are you going to be? Are you thinking joint ventureships, or are you looking at the good old investor?
Well, look, it's a combination of factors for us. And I think, or you could probably start with the creativity aspect first. So when we IPO'd, we raised $15 million. And that was meant to fund, 40 to 50,000 meters of drilling. We've done a very good chunk of that drilling, and we still have $11.2 million. And that comes because we have a team that's very, very focused on extracting value from the assets that we do have. So we sold $1 million worth of gold that we recovered from our assets in June. We sold $700,000 of surplus plants and equipment. And we've got a pretty large base of assets which are surplus to our requirements. So one, we'll keep generating income through the sort of strategic disposal of these assets. And that is something that allows us to restock our capital as we execute our mission of essentially destocking capital through exploration. The other part of that is that we're quite efficient with our expenditure. So one good rule of thumb that I sort of like to give people to think about with us is that for every meter of drilling, we spend about $200 Australian all in. So roughly speaking, $150 US all in. And on a fully all in basis, including your personnel and field support and logistics, that's actually very impressive. And one of the reasons for that is that we have lots of real estate and lots of properties, and we don't have all these excess costs. So we can stretch dollars very far. We will continue to extract value from our existing assets. We have an existing open pit that's got a high grade extension that has processed through our mill before. So When I will say that there are always opportunities to raise capital in the market, and doubtless we will do significant capital raisings in the future when we get towards development stages. But we have the ability to considerably reduce the amount of capital that we need to raise, and the reason is that we can recommission our mill and start it for $5 million as opposed to spending $150 million to build a mill.
Very good. We like it when you can stretch those dollars very far. Alex Scanlon, Chief Executive Managing Director and founder of Barton Gold. Thank you very much indeed for joining us. All the best. Thank you.
Thank you for having us.
You're welcome. Right, well, thank you very much for your continued participation. I am overrunning and you know how that makes me feel. But we are now on to the final presentation of the day. Already Jim Mellon has mentioned this company. He is a significant shareholder in our final company of this webinar. It's Condor Gold, and its 2022 feasibility study supports an updated mineral reserve estimate for its La India open pit of 7.3 million tons. We are talking big numbers. And Mark Child is the chairman and chief executive. He joins us now. A very warm welcome to you, Mark.
Yes, hello, good morning from Denver, or Colorado Springs. I'm at the Denver Gold Forum. We've had some fantastic meetings. So I'm just going to share my screen and on a presentation I actually gave yesterday, which was recorded at the Denver Gold Forum, and they are going to make it available via a live video, recorded video later today, they tell me. So I take it my screen can be seen. This has a few updated slides in it. I'd like to take the opportunity now to talk mainly about the feasibility study or bankable feasibility study, which we've done on the project and announced last week. So Minalandia, Nicaragua is fully permitted and it's construction ready in a major gold district. And this slide on the front shows our site clearance. This is taken from where the processing plant's going to be, the jaw crusher. It was taken a year ago, so we've now cleared about 14 hectares of sites. That's pretty advanced. Our base case is for 100,000 ounces of gold per annum. That's our statutory disclaimer. So the feasibility study that we put out last week, and I know I've had a few inquiries about why we're calling it a feasibility study. Well, because we're dual listed on Toronto and London, under the Canadian regulations, you have to call it a feasibility study, not a bankable feasibility study. But so it's the same thing for some people are concerned about it. Out of that, we can produce 82,000 ounces of gold a year out of a single Landia pit. The total upfront capital costs are only $106 million US, which is not much to get going. And we think actually to begin with, we can be 100,000 ounces, because what will happen in reality is we have 2 additional feeder pits and we can include inferred material in a feasibility study. You can only do probable indicated ounces of gold, which are drawn to a higher category, so exclude some of the lower degree of confidence, but it'll basically, the gold's still there, so it'll come out. So we can think we can hit the 100,000 ounce per annum target from the beginning. The mill we've purchased, as I may have mentioned, we've sunk costs of about $12 million. That's buying the land and the mill, which is one of the reasons our upfront capital cost is lower. We have an expansion scenario to 150,000 ounces by adding the underground in. We have 1.2 million ounces of underground, and we're on a major district. We've actually got, which I'll come on to. The all-in sustaining cash costs in the feasibility study are $1,039. The operating cash costs are about $850 an ounce. So just to give an idea. Country overview, we'll just say probably from a mining perspective, it's probably the best place to do business in Latin America at the moment. The government's permitting everything. You get concessions for 25 years. We've imported a SAG mill, completely import duty free, and no VAT equivalents. And just to demonstrate the importance of it to the country, I had a meeting with the president of the country. This is a map which I've used in many presentations. In front of him, we ended up with 90 minutes. And he ended up saying, well, what are your challenges? What are your problems? How can we help? Let's get the mine up quickly. That's terribly important in a continent where there are a number of jurisdictions, particularly Chile, I'm thinking of, and Peru, where people have actually had licenses and projects postponed. So important, you can actually get it out and you're fully permitted. This picture is with the Minister of Energy and Mines on the left, my general manager in from him. And this goes down very well in the local media and the local mayors and communities to see that we've got the support from the presidency of the country. The project, we picked up a very big land package and we've got 580 square kilometers. We've done studies internally that say there's an additional 12 million ounces. Now, that's a bit of geologists' arm waving, but even if half of that comes through, it's a major, major gold district. I'll come on to that later. So this is a new mineral resource estimate. We've broken out the indicated and inferred material, which we have to do under the Canadian regulations. Importantly, the first bullet point there is important. This used to be a historic mine producing super high grade gold at 13 grams per ton gold. And we've basically got 2.4 million ounces of gold. If I add in the silver content, half of that's in the higher indicated category and half of that's in the inferred category. It's low sulfidation epithermal vein system. And in the light blue, we've broken out the open pit material and the underground is in the orangey color. There are 7 different deposits here, all of which can be expanded by drilling down dip or along strike. And the areas in black are the permitted areas. So that's all permitted. And I'll come on to that now. So here are the 3 fully permitted pits. When I say permits, it's the master permit to construct and operate the mine. And everything in magenta there in purple, the outline is given by the ministry. And you've got 2.1 million ounces there. There's about 1.1 in the pit and about 1 million underneath it. So everything within that, the waste dump, the open pit itself, the main open pit of Landia, the processing plant, the tailage storage facility, that's all good to go to construct and permitted, and we cleared the site on a lot of that. The next slide will go on what's the feasibility study. So the other 2 pits to the north are fully permitted, but they're not in the feasibility study. So the feasibility study layout is here on this slide. The black line is the permit boundary that we currently have. The processing plant, if you can see my mouse, is over here. The pit is, Landia open pit is 1.2 kilometers long. And you can see that's got 900,000 ounces of gold in there at 3 grams, very high grade. We've broken out the indicators and inferred there, but 830 is indicated. That's what takes the probable mineral reserves. So once you do mining dilution, mining recovery, all your mine schedules after the blasting dilution, what you actually get delivered to the processing plant is 7.3 million tons at 2.6 grams for 600,000 ounces of gold. And that gives you 82,000 ounces of gold per annum for 6 years. And underneath it, you've got another 400,000. So that's fully permitted, good to go. And this slide, I wanted to talk a bit to the project economics. The upfront capital costs I mentioned, and that includes pre-stripping of about $12 million. There's a contingency of 15%, and there's an EPCM contract of about $8 million to engineering, procurement, construction, and management contract. If Jim's right, that's at the inflation high. So we've worked very hard to sort of strip things back to a minimum capex, maximum cash flow. So it's a real number, 106. And I think basically you're saying you can do for about $100 million, you can get 100,000 ounces of gold. So that's pretty competitive. All those prices are brand new equipment. So there's scope for sort of getting secondhand kit and taking that down. The IRRs at 1,600 gold, which we've done the reserve case at, 23%. And if we put 2,000, they're 43%. But the key point about this pit is on $100 million capex, we could borrow 60%, 70% debt, and they say 60 million, $70 million. At 1,600 gold, your gross margin's 46%. This is the bullet point 1, 2, 3, 4 down here. And it throws out $355 million of EBITDA at 1,600 gold. Back to this sensitivity of the gold price, if gold goes to 2,000, which actually was earlier this year, so it's not, it's a real possibility. You added $200 million extra just over to the EBITDA number, the third from last bullet point. So this is a very quick payback on that capital. Any debt would be 5 to 7 times covered by the cash flow, by the EBITDA number out of it. So, and an FS, just to remind everyone, is plus or minus 50% accuracy, and this costs several million, or if you add the PFS, it's over $10 million to get here to this very high level of de-risk. To the upside of this, we did a PA a year ago, which said the 150, and that was actually, just to be clear, that was 150,000 ounces from day one. It wasn't actually an expansion stage. But what we've got outside the pit, we've got another 300,000 ounces in open pit. And you can see the second point, we've got 66,000 ounces at almost 10 grams. That's in the indicated category, the higher confidence, very high grade. And we've got another 1 million of underground. The project economics, this is a new slide. So this is the project economics of the feasibility study, which we've announced. And I'll just talk through this, and then compare it with a PEA, i.e. this is where we want to get to, the 150,000 ounces of gold per annum. So in the feasibility study, using 1,700 gold, which I think is a conservative long-term gold price over the life of mine, it's all done on indicated ounces only. And we produce basically 7.3 million tons at 2.6 grams. And that basically produces your 82,000 ounces of gold per annum. The capex is only 106 million. The revenues, 943 million at that price. And the EBITDA net of royalties is just over $400 million. And your NPV zero is 170, and then you can take these numbers down, 28% IRR. That's an absolute minimum. In reality, it'll be 100,000 with those permitted pits I've mentioned. But if the underground was to come in, you can see the exponential revenues. We're going to get to $2.3 billion of revenues. You're producing over the life of mine, that number is here. If you can see my mouse, we're producing 1.4 million ounces, 1.47 million ounces of gold over 9 years, and there's a 12-month payback on this. And your NPV jumps up at a 5% discount, which is standard for Canada, 480 million. So you've got this multiple increase, because for only as $50, $60 million more, you're going to produce a lot more gold, 70,000 ounces more gold, roughly, from day one. So we've been capital constrained. We haven't been able to have the cash to drill it out, or to indicate it, and which we'd have loved to have done, but you know, we haven't been able to do that. But this just gives investors an idea of the value of where we could get to, and so the real value of the company is kind of somewhere in between those two at a future point. This is the processing plant layout, all to FS level. This is 50% engineered. So if you can see my mouse, we have the haul roads, we have the primary crusher, we have conveyors, we have a single stage SAG mill, we have leach tanks. That you can order all your equipment from this. Anything we want to get, we can order. We have warehouses, mine shops, fuel plants, engineering, assay labs, admin buildings, explosive magazines. This is an $800,000 study, minimum to get to that level. This is just showing you the processing plant design. So if you're an engineer and looked at this, we have all this in all these designs we have in a data room. We can order from this. So this is super accurate. I have foundation drawings, gold for everything from the gold room, and I could talk through the process flow sheet from primary crushing up on the top left. We've labeled all this to grind crushing circuits, goes ground down to 75 microns on the SAG mill we've already bought. So this is all being designed. All these leach tanks and CIP tanks and tailings and thickeners and detox, everything's laid out to double capacity. So if we get a big discovery, you could double this capacity in this processing plant. The SAG mill's in the country. We've paid for 90+% of that. That's it arriving. It's in a warehouse outside the capital. This is just a cross section of the pit showing some of the high grades. And you can see there's everything from 10 meters at an ounce to 54 meters at 2 grams per ton. So a great pit, and we updated the geological model for the feasibility study. This is the PEA I've mentioned. I think people have seen this before, so I'm not going to spend time on it. I've done a comparison. The resource expansion, I mentioned this very large land package we've got. This is 2 regional faults running through the system, and it's through the faults that the gold-bearing fluids come through. We've flown this helicopter-borne geophysics. We've done geochemistry and structural models. So the geologists think we are on something quite big. Just drill down the ore shoots, we can get to 3 million ounces. And here's an example of the southern end. So this is what's called a long section. The green area is the pit. The southern end of the pit, the gold disappears, and there's a fault there. It drops down 150 meters. But look at these grades. They are very high grades. There's 10 grams on four drill holes, and the width is over 10 meters. This one's 16 meters, but it's about 10 meters average width. And that's completely open. So it'll probably go down another few hundred meters, maybe 500 meters, but we got to drill it, and it looks like it's all preserved. And the other big target we've got is Cacao. We drilled this last year, some people will know, and was 400 meters of strike length, and we've actually now got it to 4,000. The drilling that we've done doubled the ounces to about 100,000 here, ounces of gold, but we're clipping the top of the system. And so the drilling that we did stepped out. So this stepped out another 600 meters along the strike length, and we kept hitting gold. And this blue line shows you the vein, everything greater than 10 meters thickness. So the geologists think, you know, it's a big, wide, fat vein, but it's going to be an underground target, and there's at least 1 million ounces here, but it needs drilling. Environmental, social, terribly important to us. We put in water purification plants. I was in Nicaragua 2 weeks ago. We worked very hard with our social team of 14 to maintain a social license to operate. We're training 120 people in the local communities for the future jobs for the mine. We have our own website there. If anyone wants to look at it, it's called minalandia.com.ni. It goes through all our social programs and work in the community. But and we've just actually last week put on our website, if you look under the environmental reports, we've put a 50-page report on environmental, social, health and safety logistics is actually on our website. That's voluntary, just to show our ESG credentials, which you have to do because mines ultimately get permitted from the bottom up, from the communities. And here's our shareholder breakdown. And as Jim has been a great supporter, and I'm very grateful for him through thick and thin. And the directors have 22% of this, so quite a lot of skin in the game to ensure this is a success. And just to wrap up on this slide, if I may, we've got a fees now, which is really respected by the market. We've had the share price has responded positively. Low capex numbers in a high inflation environment has been well received, and they're all up to date, as I say, at the 31st of July. 82,000 ounces of gold a year is a good number out of reserves. Reality, it's going to be 100,000 ounces from the beginning. We've got 3 fully permitted pits. We bought the land. We've cleared 14 hectares. We've got the SAGMA in the country. 150,000 is very visible on the PEAs we published. We think it's a major gold district of 5 million ounces plus, and quite strong economics that we've got. So on that, I'll stop my presentation, Sarah, and maybe come out of the shared screen, and can take any questions that are here.
Many, many thanks. Now you are in America as an event. I'm just wondering, what's the level of interest that's being shown in India by your peers over there?
Once you get out the feasibility study or bankable feasibility study, you get a whole new level of people who want to take an interest in the company because it's de-risked. And the conference I was at last week, half the meetings were with lenders. So there's a number of people who say, right, well, we could lend against that. It's plus or minus 10 to 15% accuracy. So quite a lot of interest from that side. At this particular conference, there are the main gold producers, the Gold Forum as America, as it's called. And there's interest from institutional investors who will come in at this stage. It's less risky. And there are always conversations going on with the gold producers who are invariably looking for the next mine, because part of the cycle, I think, as everybody knows, this is no secret, is that the juniors tend to go out, you know, and find it, and 99% don't, but we have in big quantities, do all the hard work and de-risk it, and then there's every chance that a major gold producer comes along and says, well, thank you very much, we've got the mine building teams and experience. So we've had conversations with people just wanting to know about the project. I'm not saying that, you know, that this is in any way we're being quiet or something, but it would be normal at this stage of a company of our development for the trade to take interest in the project.
So very good to hear that lenders, financiers, institutional investors are showing interest. Obviously, we have shareholders here who already have interests, and we've got a question here, which is, Mark, can you give any indicative timescales as to when financing might be agreed for the construction capex?
Yes, we're working on that at the moment. That'll take a bit of time, but I think we're looking at 3 to 4 months or so on the financing coming together. And in terms of the construction time within the feasibility study, and just so people know, in Canada, because we're dual listed, we have to file what will be a 400-page feasibility study on CEDAR 45 days after the announcement a week ago Monday. So that's going to be out in 35 days or so now. That'll be filed on CEDAR and have all the detail of the dozen technical studies from metallurgy to process plant designs will be in the FS, and that says that the construction period is 18 months. In reality, in Australia, the Australians who've done the study for us say if this is in Australia, they put it up in under 12. But we want to, that's the timetable.
Okay, so this question has many clauses to it. So I'll go on to the second clause, which is what would be the likely equity raise required to help fund the construction capex? And would you consider raising and placing this equity on the TSX market rather than AIM to provide liquidity there?
Yeah, well, there are a number of ways to finance projects like this. The debt component is likely to be private equity, gold loans, or a mezzanine combination, or regional development banks. It's unlikely to be streams and royalties because that penalizes the equity shareholders too much. So you can typically expect to get 60-40 debt to equity or 70-30 debt to equity within that. Would we look at the TSX? Yes, that's one of the reasons we're dual listed. So we're regulated by the TSX, and TSX is home to probably more of the junior space, and 60% of world's mining finance comes out of Canada. So and having a document of a feasibility level filed on CEDAR is a document that the Canadian-based lenders and equity people can readily understand and pick up, which is, you know, one of the key reasons we're actually listed there. So it's a possibility.
Okay. Intrigue. We love the intrigue. Another question, you recently mentioned a group of geologists visiting La India. Is this significant in terms of any NDAs that might have been signed with interested mid-tiers or majors? Does the visit of geologists suggest some due diligence is in progress?
Right, that might have been a throwaway comment I made, so I'm not sure where the reader picked that up, but I was in Nicaragua 2 weeks ago before these conferences, hosting a site visit. We are under a confidentiality agreement, so I can't mention names, but it's quite normal in our industry for people to knock on the door and want to conduct technical due diligence. And there wasn't just a geologist, there were geologists, mining engineers, metallurgists, and so forth. And this can be with a view to a whole range of things. Are they interested in doing a JV? Are they interested in taking a big equity position in the company, or earn-in drilling to help us get to that 5 million ounces? So it can lead anywhere. I don't know where that'll lead. What I can say is that this particular group kicked the tires extremely hard and sent half a dozen people into the country. I think that's fair to say, but all or nothing could come out of that. So, you know, caveat emptor on that.
Okay, final question is from Colin, who says, what do you think the share price should go to if your valuation between the two levels comes about, assuming the $1,700 gold price stays?
Right. Well, I think if we get a bit of sentiment coming back into the gold market, and I think we're at a low in an 8-year cycle now, actually, the last low being 8 years ago. So next year is going to look very positive, I think. I think it should be over £1. I think that's quite possible. We are penalised, as people will know, by being in Nicaragua. Although it's extremely mining friendly, the politics have been challenging, and people can just pick that up in the press. If this was in North America, let's say, it would already be valued 5 times what we are today. So there's a discount linked in with that, but that's fully priced in. I think that the trade, should they take an interest at this at some stage, I'm not saying they will look at the NPVs and valuations of the company. And they're taking a position for the next, when a mining company goes in, they're taking a 10 to 20 year view. They're not, unlike the investors, they're not looking at the next 3 to 6 months. They're putting a lot of money in to build a mine, and they're going to take a 10, 15 year view on the country. So I think that's important to look. So in terms of valuation, their valuation, we would have a conversation which is independent of the market capitalization. So we would say, look, here's our NPVs at 400 million. This is what we think it's worth. And so I think, slightly answering the question, that's why I would say the company, I believe, is worth over £1.
So you had 90 minutes with President Ortega. Well done on that. You had an awful lot to talk about, particularly as you own 580 square kilometers of tenements. So when is the next conversation? When is the next 90 minutes with the president on the cards? When's it in the diary for?
It's not in the diary, but I did invite him to open the mine and cut the ribbon with me, and he laughed at that and said yes, he'd certainly do it. So that's if not before, it'll be at the opening ceremony.
And we all look forward to that. Thank you very much indeed, Mark. It's always a pleasure. And thank you for getting up at the crack of dawn to speak to us. And all of us here at Master Investor are very, very grateful indeed. Thank you. Take care. Go and get some breakfast, or a second coffee, or a third coffee.
Thank you, Sarah.
You're more than welcome. Well, thank you to Mark, Jason, Alex, and Jim. Thank you to all of you for joining us. Thank you to Master Investor. There's been many people involved behind the scenes. And if you look at the screen, you can see that there are other fantastic webinars, events, some remote, some in person. Do go to the Master Investor website, masterinvestor.co.uk. Go to the events page, luxuriate in the offerings that we will be bringing to you before the end of 2022, which has been a most peculiar year. It has been, as I said, a pleasure. I've said that 3 times, and it's because it has. Thank you very much indeed. Take care. Cheerio.